Hello students, welcome to class. Our topic for this lesson is sources of capital for limited companies. In our last class, we've introduced students to what limited companies are and the types. However, in this class, we'll be forging into the sources of capital for limited companies. In this class, we'll be looking at shares, stocks, debentures, retained profits, loans and overdraft, trade credit, leasing, and factoring. All these are sources of capitals for limited liability companies. We'll be starting off with shares. Shares can be defined as the individual portion of a company's capital owned by shareholders. Shares are usually raised by shareholders, that is, the owners of the business, and it forms the capital base of the business. Shareholders are entitled to residual income of the company. They also enjoy the right to control the affairs of the business, and all shareholders collectively are the owners of the company. Now, what are the advantages of shares? 1. They are a permanent source of capital, and as such, they do not involve any repayment of liability. 2. Companies do not have any obligation regarding payment of dividends. And 3. Larger equity capital base increases the creditworthiness of the company amongst the creditors and investors, etc. And so now, what are the disadvantages of shares? 1. Cost of equity is the highest among all the sources of finance. 2. Payment of dividend on equity shares is not a tax deductible expenditure. 3. As compared to other sources of finance, issue of equity share involves higher flotation expenses of brokerage, underwriting, commission, etc. So now let's move on to stocks. One method a company can use to raise funds is selling stocks to potential investors. Stock can be defined as the bundle of shares or mass of capital which can be transferred in fractional amounts. Some stocks are publicly traded on the stock exchange, such as the Nigerian Stock Exchange. So what are the advantages of stocks? 1. Selling stock is an efficient way of raising funds. 2. Depending upon the offering method, the amount raised for a small business can vary under 500,000 naira to several million naira. 3. While borrowing funds increases operating costs by the interest amount, a stock offering does not. 4. An aura of success surrounds a stock offering. It signals to the company's business community that others have confidence in a company's future. And 5. This can make doing business easier, and all the shareholders collectively are the owners of the company. So now let's look at some of the disadvantages of stocks. 1. When a company sells stock, it gives up some rights to the investors. 2. If investors lose faith in the leadership of the business, the company's stock price may fall, hurting the company's image. And 3. It can lead to loss of control of the company by the original owner, as investors may decide to appoint their representatives to manage the business. Now let's move on to debentures. A debenture is a bond or a document acknowledging a loan, generally under the company's seal and bearing a fixed rate of interest, and usually giving security for the repayment of the loan and the payment of interest. Debentures is a type of debt which is issued by a company. The person who holds the debenture receives regular interest, and on maturity, the person receives the principal amount. So now, what are the advantages of debentures? 1. When a company issues debentures, it does not result in dissolution of ownership as in the case of issue of equity shares. 2. It also has a tax advantage because interest paid on debenture is a tax deductible expense, and hence the company gets the tax benefit, which leads to more profits from the company because of lower tax payments. 3. Since debenture holders do not have any voting rights, they do not interfere with the working of the organization and hence do not create any obstacle in decision-making process of the organization. 4. If the firm makes good profit during the year, then unlike equity shareholders, where you have to distribute that profit to the shareholders, the debenture holders' payment of interest is fixed and hence the firm does not need to share profit with them. So what are the disadvantages of debentures? 1. Payment of interest on debenture is mandatory, and when the company is making low profit or losses, then this payment can lead to more strain on the company's balance sheet, and non-payment of interest can even lead to bankruptcy for the firm. 2. Since debentures are considered as loans or borrowings, the ability of the company to borrow further in case of needs of funds reduce considerably. 3. Since on maturity they have to be repaid, companies need to plan properly and keep funds for the same, because when they are repaid, it involves substantial cash outflows, and if company has not maintained enough funds, it is a recipe for disaster. And 4. Unlike equity shares, which are bought even by small retail investors, debentures are bought by large institutional investors, and hence at times it may prove to be costly and difficult source of finance for the company. Now let's move on to retained profit. Retained profit or retained earnings is the capital left after dividends and tax have been paid. The company gets to keep this money to reinvest in the business or to pay off its debt. So what are the advantages of retained earnings? 1. These earnings are readily available and the company is not required to seek help from the shareholders or lenders in case of urgent need of funds. 2. The use of retained earnings reduces the cost of issuing the external equity and also eliminates the losses incurred on underpricing. 3. There is no dissolution of control and ownership in case the firm relies on the retained profit. And 4. Generally, the stock market views the equity issue as doubtful, and therefore these earnings do not carry a negative connotation. So what are the disadvantages of retained profit? 1. The amount raised through the accrual earnings could be limited, and also it tends to be highly variable because certain firms follow a stable dividend policy. 2. The opportunity cost of these earnings is relatively high because it shows that amount of earnings which have been forgone by the equity shareholders. And 3. Some companies do not give much importance to the opportunity cost of these earnings and invest this into sub-marginal projects that have negative net present value. Now let's move on to loan and overdraft. Loan and overdraft is a temporary facility extended by a bank to a company to withdraw funds from their account in excess of the balance. This facility is provided by the bank for a fee, and interest is charged on the amount that is withdrawn in excess of the balance. This simply means that a person or an organization can withdraw more than what they have in their account. So what are the advantages of loans and overdraft? 1. They help companies to handle any financial difficulties that may arise. 2. The owners of the business can and will maintain ownership of the business or the company, unlike in shares. 3. To get access to loan or overdraft, collateral are not required. And 4. They save time as it can be gotten immediately when needed. Now let's look at some disadvantages of loans and overdrafts. 1. They have higher interest rates. 2. They are short term. This is both a beneficial or benefit and disadvantage based on the business needs. A major disadvantage of getting funds from this type of loan is the fact that funding is only intended for short-term solutions. These loans will not be efficient for long-term business goals or comprehensive business projects. And 3. Loans and overdrafts must be repaid. And now let's move on to trade credit. Trade credit is offered by many suppliers to buyers to encourage more frequent and higher volume purchases. Smaller companies with limited cash on hand often rely on trade credit to make inventory purchases on a regular basis. So what are the advantages of trade credit? 1. It is easy and automatic source of short-term finance. 2. It reduces the capital requirement of the business. 3. It helps the business focus on its core activities. And 4. It does not require any negotiation or formal agreement. Some of the disadvantages of trade credit include: 1. Trade credit is available only to those companies that have a good track record of repayment in the past. 2. For a new business, it is very difficult to finance working capital through trade credit. And 3. It is very expensive if repayment is not made on the due date. Now let's move on to leasing. Leasing means an agreement between the leasing company, called the lessor, and the user, called the lessee, under which the former undertakes to buy the capital equipment for use by the latter. The lessor remains the owner of the asset during the specific period, while the lessee has to pay rental to the lessor. The different types of leasing are operating lease, finance lease, sale lease, and leaseback, leverage lease, etc. So what are the advantages of leasing? 1. Liquidity. The lessee can use the asset to earn without investing any money in the asset. 2. Convenience. Leasing is the easiest method of financing fixed assets. No mortgage is required, and restrictions involved in long-term borrowing from financial institutions are avoided. 3. Hidden liability. Lease obligations are not reported as a liability in the company's balance sheet. On the other hand, loans raised to buy assets are reported as liability. Leasing, however, helps the company to report a better debt to equity ratio. And 4. Time saving. The asset is available for use immediately without loss of time in applying for loan, waiting for approval and sanctions, etc. And 5. No risks of obsolescence. The risk of the asset becoming obsolete due to technological advancement is borne by the lessor, that is the owner of the asset. 6. Cost saving. Lease rentals are deductible from taxable income. The lessee has lower obligation in bankruptcy than under debt financing. Lastly, for this class, flexibility. Leasing arrangement is more flexible. The rental schedule can be adjusted to accommodate genuine needs and problems of the lessee. Let's take a look at some disadvantages of leasing. 1. The lessee gets only the right to use the asset. In case the leasing company is wound up, The asset may be taken back from the lessee, thereby disrupting the business operation of the lessee. 2. The lessee cannot make alteration or improvement in the asset without the prior approval of the lessor. The lessor may also put some restrictions on the lessee. Lastly, for this class, the lessee has to pay lease rentals on a regular basis to the lessor. Now let's move on to factoring. Factoring is short-term working capital that comes from a business selling its accounts receivable to a factoring company or bank. The amount available generally depends on the invoice volume. That is, this is where the company sells off its debt to another company before the debt's maturity date, and it's usually discounted. So what are the advantages of factoring? 1. Factoring is a way to finance requirement of working capital of the company in respect of receivables. 2. It provides a large and quick increase in cash flow of the business. 3. Due to the existence of many factoring companies, prices are usually competitive. 4. It is a cost-effective way of outsourcing your sales ledger at the same time managing your business. And 5. Factoring firms are specialized in their field. Thus, the company might get useful information about credit worthiness of its customers. And 6. Protection for bad debts. If non-recourse factoring is chosen. And 7. Factors check the credibility of companies' customers, which help business trade with better quality customers. Lastly, let's take a look at the disadvantages of factoring. 1. Factoring is a costly means of financing, as the cash price of the invoices is discounted by the factor company. 2. The selling company gets locked in to the relationship with the factor, as they rely completely on the services of the factor because of the cash flow implication of the arrangement. 3. Selling company fully gives the charge of collecting invoice to the factoring company and pays more attention on money collection method, which impairs company's relationship with their customers. 4. In the past, factoring was considered a sign on the financial difficulties of the company. However, in recent times, this perception has changed and it has been considered a normal way of doing business. 5. In the case of non-recourse factoring, the factoring company pre-approves the selling company's customers, which cause delay in placing new orders. And 6. The selling company may have to pay extra to remove its liabilities for bad debtors. And lastly, some customers might want to deal directly with the selling company instead of dealing with the factor. And before we go, let's take a quick assessment. Question 1. What is shares? Question 2. State 5 advantages of stock. Question 3. What are the distinguishing features of debentures? Question 4. State the advantages and disadvantages of retained profit. And question 5. Define trade credit. Good luck. With this, we've come to the end of this lesson. Thank you for watching. See you in our next class. Bye bye.